Hello, friends from YouTube. This is our channel, The Art of Grow, and my name is Fabian. Just remember, this is not financial advice. This is only for entertainment purposes. Together, we will try to form an idea of how to generate money or income. And remember, if this video is helpful to you, consider subscribe and please give us a like. Thank you. Today, we'll be trying to explain to you a little bit on how to try to buy and sell options through Webull, the app that I like better instead of Robinhood, because it gives us a little bit more information. I'll be showing you why I prefer Webull to Robinhood. In this case, I will show you in how to execute an order. First of all, keep in mind when trading options, you can only do it from 9:30 to 4 p.m. It doesn't really matter what broker you're using. It's the same across the board. So if something happens after 4 p.m. to the price of the stock, your option is not gonna change in price only until the market reopen next day after 9:30. So whatever happens in the aftermarket hours or pre-market is not going to reflect on your option only until the market reopens. Friends, so we are inside Webull main screen. We're going to go to the top corner where you guys see the magnifying glass, search, click on it, and then just type in whatever stock you guys want to buy one option for. In this case, I'm going to use a census just for the example. I click on a census, then at the bottom we see options. Click on options. Then it's gonna bring up this window here. There is many types of options, but just for today, we're gonna see the main two, which are either calls, you see here, and puts. So the calls are a bullish or positive prediction. We try to predict the price of a stock by a certain date. This date is known as the expiration date. We see here on the left top corner, which says April 16 of 2021. Next to it, we see a 100 because one option is equivalent to 100 shares, right? Remember that. What we see here at the bottom of the date are the strike prices. That is the prediction that we would try to go for, either $2, $2.50, $3, $3.50, whatever. Now the puts are the opposite. So the puts are a negative prediction or bearish. So you were saying the stock is either gonna drop or just stay at that price by a certain date. Why we do this, or when do we do this? We would try to predict certain events like earning reports, either good or bad, depending on if we know a little bit of the company or we know a little bit about the stock. Maybe we are a customer of the company. We know they have an FDA approval coming up. More sales. Companies are merging. So any either positive or negative event, and we're trying to predict that movement, trying to make a quick buck, that's why we buy these things. Now, I like Webull. Why? So let's go for the $3.50 example here for the call. So I'm on the options for calls, right? So when I click on the 350, it opens up a different window. If I scroll to the right, I see the open interest. I always look for this because it shows me how many contracts have been purchased, so how many people is ready on this trade. Number one, very important. Implied volatility is showing nothing, but it's somehow important. Now on the percentage change, I see this contract has already increased by 18.75%. That means that somebody already got in a cheaper price. I always try to buy an option if it's a call on a day that the stock is doing bad, because that means that I will try to gain that momentum when the stock is doing good. So I will get, some money. I bought on a red day for this stock. Whenever it, recovers, then I will get that money. So on this example, just to not go into more details, I will go into just click on it, like I said, and then edit. Before this, I'm sorry, we can see here, you can just choose the amount of contracts you want to buy, either 1, 2, 3, 4, whatever. On the bottom, we also see a probability option. So we click on it and it's going to open up a chart where it shows if I'm right or wrong, what are the chances that I'm incorrect. So probability mode, in the money, it's going to show me the expiration dates. So remember, expiration dates, we can choose as far as we can see here. We always try to go as far as our money would allow us, because the further we go, the expensive the contracts will be. Now, remember I told you, one contract is equal to 100 shares. This is why. So let's click the $3.50 example. So we go to edit to buy it. Here, we see that the stock, if it hits that prediction of 350, once it reaches the break-even price, which is 450, that's something that they already set up. We have the green candle thing here, or the triangle, showing that if we exceed that price, our profits can be unlimited. You see, so it can just shoot up. So now we scroll down. I'm in the $3.50 strike price, expiration date of April 16. What I like about Webull is that I know what the mid price is. Compared to Robinhood, it doesn't show you what the mid price is, so you gotta guess it. Here it's showing me that one contract is being sold for 90.90, which is actually $90 because it's times 100, and 31 are being sold for 105, which is $105. If I want to get into the trade really quick, then I will just set it up as 105, and then I will click buy, confirm, I'm in the trade. It's going to execute at 105. If I want to try to be a little bit cheap, then I will shoot for the mid price, which is 0.98, but it wouldn't let me because it only allows price increments of 0.5. So, well, I can save a few dollars and just go for 100, right? It's gonna buy at 100 if I'm reaching at midpoint in between me and the seller. So the seller is telling me I want to sell it for 105, and I'm telling the seller I want to pay you 100. It's mid in the middle, and this happens often. If you don't have the patience to wait, or this is just shooting up during market hours and you're gonna be left behind, then you wanna just pay the ask. If you wanna try to save some money because maybe you're buying a lot of contracts, or sometimes this example that I'm using is a very cheap contract in comparison to others, in which this from the mid to the ask can be hundreds of dollars, but this example is not much of a difference, but it can be of difference if you are buying a lot of contracts. So this is what I like the most about it, that I can determine what I'm willing to pay, or I'm not working in the blind when I'm trying to buy one, right? So that's number one. And then also with this strike prices is, if you see here again, it will tell you at the bottom where you go buy, saying that you're buying the right to buy 100 shares of a census for $3.50 per share by April 16. So just as an example, if a census on April 16 is actually at $5, then I have the right to buy 100 shares at $3.50, even if by April 16 is trading for $5. that means that I get the right to buy it for $1.50 less and the price is trading for at that time. So I'm gonna make $1.50 per stock times 100. That's $150 just on stock alone, not taking into consideration that I'm also making some money on the contract. The contract I paid for, in this case for the example, was $105. That's the risk. I'm investing $105. Thus I can lose that money completely if I'm not correct on my prediction, because as time goes by and it gets closer to expiration, if I'm not in the money, I'm not correct on my prediction, this price will start to decrease. Each day when the market opens, depending on the direction of where the stock is going, if it's going down, it's going to decrease. If it's going up, shooting up, then this price will move up. But also time decay, which is related to the expiration date, will always play against us buyers. It will play in favor of the seller, but the time decay will make that the price of this contract will decrease daily by a certain amount. It's not much. You always want to try to sell this contract back to the market or to someone as soon as you're making a profit, if you're not trying to ride it until expiration. What I usually do as my strategy, I always try to buy calls on days that the stock is trading red, when it's having a bad day, because I know when that momentum comes back and it picks up again, then I could be making some money. I always try to buy at least 2 contracts. So I sell one for the initial investment, which is like sometimes double, and then the next one I just wait closer to expiration to see if I can make more money or exercise it if possible. Get to buy that right. Get to exercise the right of buying certain amount of shares by certain price. This is all related to calls, but the same applies to the puts, as we see here. Also, one more thing, you always try to shoot for a longer expiration date, because that will give you more time for the stock to try to recover in case it had a bad few days or weeks. But the further you go into expiration dates, the expensier the contracts will get, because you have more chances to be correct, right? So instead of paying $105 that it was for the April 16, on the July 16 is $175. So it's about $70 more than the other one, but you have a few more months. And if you're in the money on this, it could be, really good. So that is for the calls. The puts, we try to predict the price of the stock going down. And for April 16, the puts of $2 are trading for only $10. These people had lost about 44% on this trade. So that means that was at a higher price, but since the stock is going in a positive movement, is being bullish, then the puts are losing money, right? Because they are incorrect and they're getting closer to their expiration date and they're further away from their prediction. As we can see here, the stock has been increasing from 3.9 up to 4.150. That is what it closed at. So you're always going to see here on the options, the price of the stock is right at the middle, and then your strike prices or predictions. The bid is the minimum price that the contracts are being sold for. The ask is going to be the maximum. You're going to see a percentage change. That's going to give you an idea if you're overpaying, or maybe you're saving some money when you're buying this. It's still 18% less for the puts, but on the calls you're already overpaying by 18%, In some cases, that doesn't really matter, because if the stock is gonna continue to increase in price, you know, your profits are gonna be way more than that 18%. Sometimes in some trades, it could be, you know, 100%, or even up to, you know, thousands. The most I've gone in some of the options trading that I've done is maybe like 150% at most, because I always try to, you know, exercise or get out of the trades by then. I just don't really like to risk it that much. And that, my friends, covers a little bit on how to trade options from within Webull, and a little bit of what options are. If any of this information was useful to you guys, remember to please subscribe and give us a like. Remember that if you have any questions or any corrections, we're here to learn together, try to form a tribe in which we can inform and grow together in the way we invest. Any information for me is also useful. You know, you can share ideas, and anything you guys want to add to us is of great help to grow together. Thank you for joining us. Have a good day. Take care. Be safe.